Today, we are talking to a guest investor that has done the thing that we all like to talk about. Her property has had 7 babies. She has a whole family of properties funded by one or two properties that she originally purchased. We're going to talk all about that today. Welcome, everybody, to your weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, Greg Cohen is at the new JWB headquarters. They're giving their JWB State of the Union, which you will get a preview of next week. But today we have a guest investor with us, a avid member of the community. Many of you may have met her at Summit last year. She is a financial advisor with New York Life. She is born and raised and continues to rule over New Jersey. Sarann Jennings, welcome to the show.
Thank you, Pablo. Good to be here.
Yeah, good to have you. Good to have you. And I'm excited. I feel like we just did a show, you and I, and now we're just going to kind of like rehash it with our friends here. You were just telling me right now that you are coming to the summit and you are thinking about getting another property at the summit, which we're going to talk about in a second. But let's talk about this idea of your properties having babies. I feel like we talk about this all the time. How would you describe that to someone? Don't give me the whole history. Just like there's a bunch of new folks here. What do we mean by properties having babies?
Well, I'm very excited about my properties having babies, but what that means is you're literally taking the equity from the homes that you have, and that births new homes. So you don't need any money out of your pocket. You just utilize that equity to get more under your portfolio. Yeah. And then, as I was saying to you, it gets faster and faster. I feel like the more you get, the faster you can acquire.
Yeah, we're going to talk about that. All right, so let's talk about this. You were telling me essentially that you bought a property in New Jersey in 2008 and self-managed that for a while. Tell me why you first got into the real estate thing.
I have always thought that real estate was a phenomenal asset to have in your portfolio, and I wanted to own a rental property. So my husband and I bought a rental property in New Jersey in 2008, and it was very, very challenging. I was managing it myself while working full time, and there was everything that you could possibly think happened, right? The guy with 10 cats living in there that never let them out. The guy who like left the water on and then got mold and said he had to sue me because there was mold in the house. Like, just, there's all these stories about things that happen when you're doing these things on your own. At one point I wanted to get out because it was too much work. And then the home was underwater, meaning I owed more on it than it was valued at that time. And I think we talked on the show last week, or everyone was saying that this is a long game, right? It's not a couple years or 1 year or 5 years. It's a longer game. So I stuck in it. My husband and I stuck with it just because it would be a really bad decision to sell it while we owed more money to the bank. So we owned that until recently.
Yeah. We'll get to that part, right? So
yeah.
You mentioned this idea of being underwater. I would say 2008, it's kind of like the stories of JWB where they started in like 2006 and bought like 40 homes in like 2008. People kind of like look at it and think it's the worst time ever to have bought a rental property kind of thing. Were you getting in like right as the market was tanking? Like how quickly after buying that property did the world kind of like change around you, or were you doing it already because it was already going down? Or tell me a little bit more about that.
You always think, or I have always thought, you get to these points in real estate and like, oh, it can never go down any further, or these prices are never going to get any higher. But what I have learned all through the years is like, yes, anything can happen. It can go lower for longer, or it can, double in price over a short period of time. So I wasn't really that strategic. I just really wanted to get in, and I got in. And then over the next couple years, I knew I was holding it for a long time. I think I really realized that I was underwater when I just felt like I wanted to get out and I
Yeah.
couldn't,
Yeah.
so several years into it, I was like stuck.
Yeah. Yeah. And
Yeah.
then at what point, so I know that, so you went through that experience, you held on to it. At what point did you decide? I know that you came from like the fortune builders community as well. So like that tells me you at one point made the conscious decision of investing time and money into getting like really educated on real estate. When did that happen? How did the light turn on for that?
Yeah. So I mentioned to you before that, in 2020, I had a big reorg at my company and I had to change careers, right? So one that gave me access to my 401k, which was cool. But the other thing was I'm like, I'm diving into real estate. Like I love it. I love finance. I love real estate. I love investing in all those things. And, saw fortune builders and my husband and I were like, all right, we're gonna do this. Well, lo and behold, I'm going around Jersey looking for homes and it's 2020 and everything's stopping. And I realize I don't know a contractor. I don't know a painter. I don't know a lot of things. And I thought, ooh, this is going to be tough,
Mhm.
to do this. Not that I didn't have the tools to do it. I don't know if I really had the wherewithal to get it going like on my own at that time. And I just thought, oh, 2020 might be a tough time to start in this. And as you know, I don't know, like you probably know, everything was getting more like labor was more expensive and like
That's right. Yeah.
supplies were more expensive and I had the spreadsheets and the spreadsheets weren't working. So I was just like, you know what? Let's just invest and I can, focus on the other things that I do. And I was introduced to a company similar to JWB in Kansas City.
Got it.
And that's where I took my 401k, turned it into a solo K, and purchased some homes in Kansas City.
Got it. So 2020, I guess you had experienced what most people experience, which is the idea of like, I'm going to invest in my backyard in 2008, bought during a very challenging time, made it through, self-managed all the way through. Did you at any point get a property manager?
Nope, never.
Self-managed all the way through. 2020 hits, you get educated, you think, all right, if I get educated, I can do it again, except with better strategy or whatnot. You realize that it's only gotten harder because of COVID and all that. And that's when your eyes opened up to this idea of passive rental property investing in a different market completely. Like what had to, you know, what had to click for you to realize that buying not in your backyard is something that is even like not crazy?
People would think I was crazy because they're like, did you see these homes?
Yeah.
Are you going to go there? And you have to get used to the point that this is an investment, right? Much like any other investment you do, this is an investment. And property taxes, homes, they're very expensive in New Jersey, right? So the rent to value is lower here, whereas in Kansas City or some like working with JWB, there are homes that have a nice entry point that you can get in, but the rents are just as good. So you're really like your cash flow is much better. Like here, I was always eking it out. At one time I was paying, and I thought, oh God, I'm never going to do this again. I'm never going to have to take money out of my pocket and pay the mortgage because that puts you in a very precarious situation unless you have, just unlimited cash flow. So my husband thought it was crazy, but I was able to let him know that this is going to be a good idea, and we did it.
Cool. Got it. That is, to me, that's such like a watershed moment, right? Like I wish that I wish that when I was in Miami in like 2014, 2015, I wasn't thinking everywhere in all of the United States has this like impossible like to understand real estate market of like how can somebody be buying this thing right now, right? Like the idea of not having to invest in your own backyard. I think you put it really well. It's like prices can be much lower while the rents are very, very similar. Creates like a really good dynamic that essentially becomes the foundation of why the investment becomes so attractive, right? Like once you're at that
Right.
like break even slash cash flow positive point, now you can really start thinking about it as an investment without like that scarcity mindset of I have like no margin for error because I'm coming out of pocket all the time.
Yeah. Yeah. I mean, it's scary, no
Yeah.
doubt. You
Yeah.
know, it's not
Yeah.
for the weak.
Yeah, yeah. Well, we were just talking about that, right? So all right, so speaking of scary, right? Like you did that. You're telling me that you invested in Kansas City. I I guess I'll let you explain it, but you basically explained it as like the management company there didn't exactly give you like all the confidence in the world based on like how they communicated. Can you talk me through that experience and then what made you want to then do it again with a different management company in Jacksonville?
I never stray from my thought that real estate is an unbelievable asset to own, right? But there were challenges in Kansas City. They just weren't as communicative. The homes I actually purchased weren't as in good of shape as we originally thought.
Mm.
So there was some challenges there. And I learned there was probably things that I could have done better, like check on certain aspects of the home and make sure that they were in place. But so there was challenges there, but they changed management companies. I got new people. Everything's going okay. It's going okay right now. But there was a lot of bumpy roads during that time. So this is 2020. 2021, I was able to purchase one home in Jacksonville. So now I'm able to compare Jacksonville to Kansas City, to the management company, to everything like that. And I cannot tell you how night and day it is. JWB is so communicative, even on things like, hey, I want to let you know, we know there's a storm coming. We told all of our rental tenants to take things out, take things in from the outside. We don't want things blowing around, calling to make sure like your rent's in. There was no issues. There was no the other company, I just get, you have that portal or whatever. I just get things like, what's this $500? Just, oh, the drain was clogged again. We didn't tell you. Like, I have never had anything like that happen. So I feel as though I'm very comfortable, very secure in the fact that JWB is really taking care of these properties and the people in them.
That's interesting. So I don't, as you know my story, right? Like I became an investor only because I host this show and I got surrounded by other people like you and Lee and Leslie and Andrew and Drew Barnhill and everybody in the chat, right? So like I've just never had anybody to compare it to, but it
Well, you're
feels
lucky.
like, yeah, that's what I guess, it's, what I'm hearing, like what I'm hearing from you is the Kansas City experience, right? We talk about turnkey rental property investing, right? Like, and the difference between turnkey and vertically integrated. And turnkey will often be someone who sources you the deal and then brings you a management company, and they, like they hand to you as like a package with other companies, while vertically integrated is all one company. And from hearing what you're saying, if they're like switching companies to like get it right, that's that turnkey model, right? It's not the vertically integrated model,
Right.
as much as that. And then JWB is all in one place, right? Like you're never gonna switch management companies. It's like one company that's doing it all. And I think that the variability that you're talking about in the experience is kind of like the first time that anybody has ever highlighted that on this show. This idea that like they'll switch out a company completely. It's not like different portfolio managers or something like that.
Yeah, I mean, it's a scary thing anyway, right? You have to have trust. You have to have,
Yeah.
it's a lot to purchase a home in another state or area and have somebody
Mhm.
completely, taking care of it. And when you have that uncertainty of people changing, or they're not sure what's going on, or there's a lot of turnover in the tenants, it's not that vertically integrated company. It's just kind of piecemeal, and you feel that, right?
Yeah.
Like the people, JWB as a company, like from the very beginning to the end, like they take care of every single piece. Like when I'm purchasing these new properties, like I'm sure a lot of people know, you get that email, "Hi, here's your team. This person's going to do this and this and this, and I'm this person, and contact me for that." Like you never feel like what's going on, what's happening. There's always someone to call or check on, or they have the people, even the mortgage, and like everything works in tandem. And I'm kind of going on a tangent, but even like I work with Sam in JWB and doing, looking at the homes. What homes do you want to get?
Mm.
And my husband and I are going through it, and how easy could it be would to say like, okay, you can afford this, get these. And we were going through which ones, and she really said to us like, what is your goal? Like, let's go back. What is your goal? And we said to own as many properties as we can. We want to ultimately get these cash flowing for our retirement. But right now we're getting as much as we can under our portfolio. And we were looking at that one beach house, right? That they
Yeah.
have. And she
Yeah.
goes, "No, like these homes would be better for what you want to get." And I really appreciated that, because it wasn't as though she was selling more to us. She was selling what was right to us for our portfolio. And I was like, wow, like you don't get people like that much, that are really looking out for you in the long term.
I love that, Saran. We don't talk a lot about the JWB sales process very often. I I feel like when I went through it, I'm so kind of like ingrained here that I just kind of like rushed through it.
Yeah.
But since you've been through it on both sides of the fence, right? Like, can you tell me the difference between, so let's reverse a little bit. What is your why, right? Like, what is like, I know that a big part of this is a why. Like, what is your ultimate goal? Is it a number of homes, and for what reason?
Yeah, my goal, I think someone last week said 30, so I feel like I have a low goal, but my goal is 15 homes. Why? Because mathematically I figured it out based on other things that we have, that would be a very comfortable, great retirement if I could get 15 homes under my portfolio, have them all cash flowing, right? And ultimately like pay
Mhm.
them off and work with each of them to
Yeah.
pay more and more off as time goes on. My husband sometimes says like, we got to own things. And I'm like, we're in acquisition phase. We got to put as many as we can now, and then pay them down. My why is because I want to, sometimes they say when you're retired, you're going to need less money. I don't buy into that at all. I want more money. I want to go out. I want to travel. I want to go to dinner like every day Saturday, right? It's the time that we're going to be, going all over. So I want to feel comfortable. We have investments and things, but they can be volatile. This is something that I feel very passionate about, that it's going to provide literally like a paycheck every month. Will there be problems? Yes. Will something need a new roof? Yes. But ultimately, this is going to be something that will continue to grow. You're going to get price appreciation. You're going to get tax write offs. You're going to get, it's just, there's so many good things that are good about it.
Yeah, I love that. Like the thing that speaks to me the most is what you just mentioned there at the end. It's the stability, right? Like the idea of when you have 15 homes in your portfolio and you've dutifully paid them off and used the extra revenue to get there, and now they're like cash flowing really, really well. A month, like one or two of them going vacant for a month or needing some kind of repair is a much different experience than like what the world is experiencing now, between whether it's some kind of geopolitical conflict that makes commodity prices go crazy,
Right.
or
You
something
don't know
crazy
what's going
happens
to
in the stock.
happen.
Yeah, totally. That thing has landed more and more on me the more that I'm a part of this community and a part of this show. It's like the consistency piece is awesome. And the idea, which we'll get into this idea of like properties having babies, but like the idea that at that point your options become really really good, like your ability to pull cash out without having to pay taxes, without taking a haircut on something like that, and do interesting things with it, to me has become like the big differentiator between this asset class and other asset classes for me. So tell me, let's get into that. Let's get into this idea that at this point you have your house in New Jersey that you got in 2008. You bought one or two in Kansas City in 2020.
3 in my solo K.
You bought three in your solar K in Kansas City 2020.
I
And
took
then in
my 401k and bought homes with it.
there you go. And then in 2021, you purchased a home with JWB here in Jacksonville. And then at that point, you chilled for a while, right?
Yeah, I
Tell me
was
what's
on
happened
chill
since.
till last month.
Till last till last month, you went zero chill.
Zero.
Tell me about what happened last month.
So I had worked really, really hard to in those solo K. Now in a solo K, you normally have to put more down on the property. So we had some equity in there, and I took any overage of any rent and put it towards the first house. Then that was paid off, put it towards the second house. So in 5 years, I paid off those houses, believe it or not. Insane, I think.
In
Um,
five, hold on, repeat that.
yeah,
So then, all right, so give me that math again. I was reading a comment from Richard that I want to talk about in a second, but like, give me that math again.
yeah. So, and then in 5 years, I had paid off those 3 houses.
Okay. From just the cash flow from the rent?
There was one influx of cash that I was able to put in there that did help, but
Okay.
mostly it was from the rent.
Okay. So, and then, and then it just kind of like, you said that it, like they call it this like snowball method, right? Because it like accelerates, like once you pay one off, then the other ones get paid off quicker. Just give me a little bit more on kind of like the experience of like the discipline of doing that and thinking through it and kind of like how it felt as it went on. Was it harder at first and then easier later on?
When you say harder at well, yeah, it goes slow, right? You
Yeah.
see nothing. It's like a snail moving. It's like nothing's really happening, right? Like you get 200 or $300 maybe cash flow from one home that you're putting to the next one, right? So
Mhm.
now, and you're paying that down. Then you get one paid off, and now you got eight, you got the full rent of that plus the 300 extra dollars from the second home
Mhm.
that was cash flowing.
Yeah.
Now you're paying, $2,000 a month of that. I know my numbers aren't working out, but I figured these next homes I can probably pay off in 11. It's going to take me 11 years with just the cash flow of the homes.
These next seven homes you're going to pay off in 11 years with just the cash flow of the
Correct.
homes in today's prices.
Yeah.
Interesting. Interesting. Okay. Okay.
Because
Yeah.
what I did was, right,
Yeah.
JWB tells me, like, I know how much cash flow I'm getting from each home. I'm going to
Hmm.
take all of that and put it to the first home.
Yeah. Are these in a 401 in a solo K, or are these outside of retirement funds?
Okay. Well, I have two sets of babies that I
Uh-huh.
had. So in my solo K, I refinanced and I bought 3 JWB homes. Then the Jersey house, I ended up doing a 1031 with JWB's help, and I bought 4 more houses.
Hmm.
So I turned 1 to 4. I had $3,000 a month rent into like over $6,000 a month rent.
Let's go. Financial engineering. All right. So I don't think we had mentioned that yet because we kind of like fast forward to that math of paying off the homes in like 5 years. But what happened in the last month is that you've picked up seven new homes with JWB. One of them came from refinancing that Kansas City portfolio and picking up three, and then or four, and then the other one
3.
came from, yeah, picking up three, and then the other one came from 1031 exchanging the house in New Jersey that you bought in 2009, and that afforded four homes. I assume that they're all four homes at 25% down, 20% down.
I did 30% down and then
Okay.
like higher on one. It was like 50% down.
Higher for 50%
So
down. Got it.
that'll keep it cash. I mean, I could have eked out maybe another one, but I was like, you know what? You got to wait out the husband too. So I'm
Let's
like,
let's let's talk
all right,
about
we'll
that.
do it this way.
Yeah, yeah.
But
Let's talk about the husband piece, right? And I think this is kind of what Linda's asking about. She's like, is she not leaving anything back for property turns or repairs? I'm going through this right now. I was just telling you, right? Like I bought the bulk of my portfolio in 2021 with JWB. So I'm now at the point where I have enough equity to maybe have some babies, but I'm also at the point where I'm really enjoying my cash flow that I'm getting from these rental properties, and that feels really good at night. And like it makes my wife happy to see our savings go up and up and up every single month. Whether like this, we're putting stuff away from our W-2 jobs, but then we're also seeing this like extra increase in our savings happen, and that feels psychologically really, really good. So
safe.
huh? Yeah, it feels safe. Exactly. So when you are now then having the conversation with your husband to say, okay, now we're going to do this again. We're going to refinance this again. And we're going to go into another period where we're kind of like building up that cash flow over time. What's that conversation like?
It's really about our ultimate end goal,
Yeah.
right? Because we were seeing cash flow and that did feel good. I was like, "Oh, wow. Like, this is nice. It feels good. It's like a cushion and you really really want that." And I thought about that for a while. I was like, "Well, do I want to give this up because I gave it up?" Right? I'm not getting that cash flow anymore, and any cash flow I get, I'm putting it into paying the others down. But I had to sit and explain, and he's very good, right? He lets me go. He's always like, you have these crazy things you want to do, and he supports me if it makes sense. But he's been like, people need to own things. I'm like, but we're in acquisition stage, right? So our goal is to get to that 15. So to get to that number before we're 100 years old, we've got to we've got to do it. We've got to do it now. So we're going to not take the immediate gratification and safety and trade that in for something bigger in the future. Just the way we feel.
Yeah. Yeah. I'm glad you said that, the immediate gratification piece, because that's what when we were talking pre-show about this, like the first thing that I went to my head is like, oh, Sarann and her husband have really bought into this idea of it makes sense to delay gratification if you're very, very clear on the outcome that you're trying to get. And you've developed another level of comfort or safety around something else that isn't monthly cash flow. You've developed like a level of comfort or safety in your ability to hit this goal.
Hmm.
Does that ring true to you?
Absolutely. Absolutely, because I believe in that end goal, and I see that. And there'll be turbulence along the way. It's not all just like going to be smooth sailing, but I'm so thankful that we have a company like JWB that we can work with, that I trust. Trust is such a big thing, right? Trust is huge. And I know they're good people, and they're operating from a place of doing the right thing, and that's where I'm going to put my money. There's a lot about Jacksonville growing. There's no guarantee that it will, right? Like there's no, like I was telling you before, people, I talk to people in New Jersey, they're like, why Jacksonville? Like, why not? Like there's a lot going on there, but it's not on the radar.
Yeah.
It's not on the radar all over the country. But I do believe it is a great place to invest. And based on what I call it Gribbon, my first baby down in Jacksonville, based on what that's done, I feel really confident in this strategy to keep acquiring and get to our goal.
Yeah. Yeah. It's funny because as you're talking about this, I'm hearing you haven't mentioned the property itself once, You've mentioned the team now multiple times, and you've mentioned the market now newly. So it's like, this thing that we talk about on the show over and over of how the average rental property investor will be like, "Oh, I found this property and I'm gonna get this property," and then thinking about who manages it comes secondary, and often the market that it's in is just like dictated by what's your backyard, while like experienced investors like yourself that did this in 2008, then did it again in 2020 and have like been through this rinse and repeat cycle a couple of times, the order of operations really is this idea of like find the management company that you really trust that can help you feel like you're going to reach your goals and you can trust it over a long time. Understand the market enough to think that it's a growing market and that it's going to do well. And everything else is kind of like, I guess you mentioned property selection kind of like at the end point of your sales process, but it was all in relation to the goal and how you were getting there. It's like a pretty cool, I don't know, I'm having like an aha moment here.
That's really cool that you say that because I didn't even realize I was doing that. But you're
Yeah.
absolutely right. And that's
Yeah.
what I was doing in 2020. Right?
Yeah.
I was like running around like, "Oh, you got to come see this property. You got to come see this property." But it's kind of like when you start the other way, right? You start with a company like JWB. It's like you're inverting it, right? You
Mhm.
have the company and then you can get all your assets underneath. It just makes it very very easy. You're not working bottom up like here's one property, two property. It's kind of like I don't know. Yeah, you got to trust who you're working with and then go from there because there's rental properties all over the country.
Yeah. And that's what Greg talks to me about all the time is like we had to make this thing scalable for people. Like if someone like Sarann's gonna plan their retirement around this, then the
A
ability
big
to like
responsibility you
it's a
guys
big
have.
responsibility. Yeah, it's a big responsibility. And like the ability to like meet that demand of, hey, over the last 20 years, be able to sell people a property that works to a certain level that they have established and continue to deliver on the properties that they've already, like put in their portfolio so they can continue to like meet these goals as opposed to having to be opportunistic whenever it's available as opposed to like unlike doing it on your own schedule as you just continue to grow and be in your acquisitions phase, is to me like the big magic in this like business model that they've created that has now lasted 20 years and has been this it's like they've created like a new form of like manufacturing wealth that I find really fascinating.
Yeah. What did I say to you earlier? They have the best job in the world. They go around making people's dreams come true. Like that's pretty cool.
Yeah, that's true. Let me ask you a couple questions here from the community.
Okay.
Richard Drennan asked a little while ago here, as part of the strategies using equity from rental homes to purchase more, what is the ratio of rentals debt-free to those with mortgage? It seems having a lot of leveraged properties is risky. Leslie said, hey, this is all personal, kind of like what your level of risk is. But can you tell Richard a little bit about how you think of this idea of your ratio of debt and stuff like that versus having things paid off?
Yeah, I am more of an aggressive individual, I think, when it comes to finances and investing and things like that for my own personal portfolio. So right now, we have mortgages on every single house, every single one that we own, because I'm in that acquisition phase. Now, there is 30 to 40 to 60%, what did I want to say?
Debt to equity?
Equity in there,
Yeah.
right? Up to 60% equity in some of them. So if something were to be, happen there, you possibly can get some equity out of there. But I guess, I'm a little bit more aggressive, so I am just trying to acquire. I know some people may not agree with that, and that's okay. You don't have to do that. Do that with half your homes if you want. But that's the way I'm getting to my goal as fast as I can.
I like it. Yeah. And Leslie, rightly so, is saying Sarann's using the five profit centers by using the leverage on her portfolio, right? So, like Richard, I don't know if you come to the show often, right? But the five profit centers are the cash flow that you get when you subtract revenue minus expenses, the appreciation that happens over time, the tax savings, the debt pay down, and then the inflation hedging that happens. So, what I'm hearing in Sarann's answer is essentially she has enough cash flow that is happening. So it's like you don't own anything, everything has a mortgage, but your revenue exceeds your expenses by an amount that you are comfortable with based on knowing how well the management company performs over time
Mm-hmm.
and how confident you
Mm-hmm.
feel in those numbers. As that
Mm-hmm.
continues to happen, cash flow goes up over time because rents go up and you have a fixed cost of what your mortgage is. And appreciation does its thing. So equity continues to grow. And with those kinds of like dynamics, you can have something that's not fully paid off, but is still completely stable that over time gets better. And like you referenced, if you ever get in a pinch, that equity is actually something that you can access well before having to sell the home as well. So there's a couple different layers of like mitigating risk that happen well before, owning a home outright. How'd I do there?
Yeah, perfect. And I think too, my thought is I could have cash flow, right, from
Mhm.
one or two houses. I could say, I'm going to let them be paid off and I'm going to take that cash flow. But in my mind, I now have seven more profit centers that are now in a position to appreciate in price, to give me a tax break, to pay down my mortgage. Like, and that to me is more valuable than the safety of one or two homes with that cash flow. And that's just the way I think. But now I just feel like I have so many more things growing for me.
I like it. I like that you multiply the profit center per property. So
Yeah,
it's like you got 5 profit centers, but 7 properties. So now you got 35 more profit
that's
centers.
right. 100%.
That's cool. That's cool. And all right, so Linda Evans had asked this earlier, and then Mike Foster wanted to ping it again. If you're aggressively paying down mortgages with cash flow, do you leave much in reserve to cover normal expenses and turns and stuff like that? What's your reserve strategy when you are every month like using the cash flow to pay down a specific mortgage?
So I keep just and I worked this all out in the cash flows when I was purchasing the properties, but I keep a certain cash back in both my 401k and my business checking account for the homes outside of the solo K, just
Mhm.
in case anything were to ever happen. If like Gribben, right, my Jacksonville house that was outside of my out of the solo K. So the monies would go in, and if ever it starts building, right, that little bit that's extra, I might pay down the mortgage a little bit more. But I
Mhm.
always want to keep that, you know, cash amount in there.
Yeah.
And it may not be a comfortable amount for people. I'm pretty trusting of the world and I'll be like everything will be all right. But that's how I do it. I mean, there is cash in there. It's not as though, there's nothing. And if I needed a hot water heater tomorrow, I couldn't do that.
Yeah. Do you have like a number that you hold per home, or are you just kind of like X is what I need based on no matter how many houses I have? Are you comfortable talking about that
Well, you know
number?
what? I was pretty much X,
Yeah.
but that now that I'm adding all of these homes, I probably
Mhm.
do need to rethink that a little bit.
Yeah.
Do I need per home? Do I need, because that has to change a little bit because I'm literally doubling the portfolio, more than doubling it. So yeah, that's probably a really good thing for me to really think through and make sure that I have enough reserves.
Yeah. That's something Matt and I
But
have
like
talked
I
about a
always
lot.
say, like I call it the waterfall, but I'm taking all of the money and putting it right towards that mortgage. Now, if
Yeah.
something were to happen and my reserves went lower than they should be, I would have to stop putting it towards that mortgage, right? I have to let it build up a little bit.
True.
So it's like an ebb and flow. There's no like this is exactly what's going to happen because we don't know.
Yeah.
But that's kind of the strategy I use, but I know that I can pull back on overpaying the mortgage if needed.
Yeah.
And the
That's a
more homes you
that's a
have,
really good
the
point.
more that builds up.
Yeah.
Because you have 200, 200, 200, 300, and then, it builds up to a significant amount.
Yeah. Yeah. That's a really good point. When you have 7 properties that are like cash flowing between 2 to 400 bucks a month, and you have the luxury of putting that like, I don't know, call it 2,500 bucks a month towards paying down one mortgage, you also have the luxury of taking that $2,500 a month and buying a water heater with it.
Exactly.
Or whatever you need, right?
Exactly. Like you're not
Yeah.
tied into that. That's the
Yeah.
strategy, but you can
Yeah.
change it if you need to.
True. And then you have whatever cash reserve you have there, that is probably what you're using. And then you have the luxury of using that extra cash to rebuild that cash reserve to like smooth out the lumps.
Right.
And if you miss paying, the C3, like the debt pay down strategy by like 1 or 2 months, not the end of the world. But you know that every month you're going to have that cash flow machine re-upping for you as you continue to build that portfolio numbers.
Right. Exactly.
Yeah. Yeah.
And what I'm
No.
realizing is the more you have, the actually easier it gets.
Tell me more about that.
Well, when you have one or two rentals and you have, $200 from each cash flow and you have $400,
Mhm.
right? And then you have only that $400 to pay down the next one. So it moves very slowly, right? And that's where I was in 2020. It was moving slowly for certain things. And then when you look at 7 additional homes, like you said, I have I think over $2,000 in cash flow from from the 1031. That's
Mm,
just gonna keep paying,
yeah.
those other things down. So look how much more cash flow I have just by having more homes.
Yeah.
Now you can have more problems. I get it. This is all new to me too. I'm just adding all of these now, but you know, I see that. I'm like, this is really, really cool because now I have more money to pay more down even faster.
Yeah.
And, it could be good. More babies.
More babies. Populate the earth. Leslie Brooks has a really good question that I didn't even think to ask. And I feel like it's something I should have absolutely asked. So, Leslie, thank you for bringing this up. Leslie's asking, what's the process of, like what are the process and the requirements to use equity in your current investment properties to purchase new properties? Can you just kind of like talk us through what you had to go through to like refinance these homes and buy these babies?
Yeah, I mean, it was actually super simple. I just I called JWB and I said, this is what I want to do, and they hooked me up with a lender, and I just said I want to refinance these homes, and they worked it all out for me. That's the beauty of it too, right? Like I didn't have to think about all this. Like they worked it out and said, okay, we can take this much cash out safely with you still cash flowing this much. With this much cash, we can buy this many homes safely cash flowing. And then you have twice as many homes cash flowing. So it was just super simple. It's the paperwork and all those kind of things, but which can get cumbersome sometimes when you're purchasing homes. But I felt really comfortable knowing that the homes I was refinancing will remain cash flowing, and then the new homes I was purchasing will be cash flowing.
Yeah. Yeah, that makes sense. I think right now is a good time to just kind of like go over what that looked like, right? Because what you're saying is essentially JWB was able to break out the numbers for you to like they did the math to help you make the decision, and then they introduced you to the mortgage company that would then handle it for you, and then from there it's basically just paperwork. Like, is it,
Yeah.
something I'm just going to ask selfishly? I hear all the time that refinancing, like when I think of getting a loan, I think of like getting a root canal, right? Because getting a mortgage on my house sucks. But I've heard that refinancing homes like that is actually like a much simpler process if you're just doing a refinance.
Well, the ones I refinanced were in my solo K, and that was really, really easy. They
Okay.
don't even need much from you. But I was thinking maybe that was because it was in my solo K. That was very, very simple. The homes I'm purchasing now outside were not a refinance, but a 1031. But I'm still going
1031.
through all of the finance stuff. And the woman that I'm working with sent me one great email. These are the things that I'm going to need. I had a checklist, and I just worked with my husband to get those things over to her, and then was like, wow, I did that like in an hour. That was pretty cool. Like, because normally I'm the root canal I'm thinking,
Yeah.
my God, now you want blood from my first child and my fingerprints and what?
Exactly. Yeah.
Yeah,
Yeah.
it's
Totally.
crazy,
Okay.
crazy.
Cool. So that validates that. So it's a much simpler process, especially like working with JWB. They help you make the decision, which is probably the scariest part, and then everything else is just like a checklist, and you know where
Yeah.
you're going. Yeah.
Hmm.
I think it's worth bringing up the idea that I hear a lot on the show. This idea of like people are like, well, why not use my own lenders and stuff like that? JWB has this like approved network of lenders, not because they have any kind of referral relationship. They don't make any money on it. They will only set you up with lenders that have done this hundreds of times and make the process really, really easy. And that feels like a data point in that journey. So let's
Yeah.
look at this number that they broke out for you. All right, so this is your one property. These are real numbers, right? So like do your own due diligence on things like that. This shows for informational purposes only. That being said, you mentioned Gribbon a couple of times, right? This is
My
your
baby Gribbon.
your Jacksonville baby Gribbon. Purchased on May 18th, 2021 for a purchase price of $205,000 with a conventional loan. Your total investment was 56,000. So I'm looking at that. That looks like you put down 25%. That looks like then somewhere around there.
Uh-huh.
Um,
Do it.
and and you've recently purchased seven more JWB properties to now have up to eight total. But this one, as it's matured from 2021, you see this return right here, right? Like this is Sarann's Pac-Man that we like to call it when we break out the five profit centers here. You see this. I need to make this a little bit bigger for myself to break it down. You see that in that amount of time, number one, you got a 27.4% rate of return, which is nuts. A total profit of $124,000. And it's broken down by the different profit centers, right? So you see the $90,000 home price appreciation. This is why we call it the Pac-Man. When you lay it out on a pie chart, it looks like the body of a Pac-Man, while the net rental income that you see over here is $15,000. Their principal pay down over here about equal, another $15,000. Tax savings over here, $3,000 is the mouth of the Pac-Man. So essentially, what I'm guessing, Sarann, is that they looked at a similar calculation to this, where you had this like $90,000 in home price appreciation, told you you can refinance and pull out whatever number out of this was to then put back into purchasing these three JWB properties, and that's how they guided your decision.
Yeah, now I didn't refinance this one yet.
Oh, this isn't the one you refinanced. It was another group
This
that
is still
refinanced.
Gribbon's still
Got
pregnant. But the other
it.
one, it was the 1031 in New Jersey,
Got it.
and then I refinanced three in my solo K.
Got it.
So
So
this is
you've
on deck.
yes. Okay. So this one's on deck. Is this the one that you're telling me that you're thinking about getting a new property while you're here in Jacksonville in for the summit?
I
Got
want
it.
to make it I just decided I'm going to make it a goal to buy one every time I come to the summit. Why not? It'll be like a little tradition.
That's so
If
cool,
I can
man.
do it.
Yeah, that's amazing. Yeah, that's really cool. That's really cool to think that you're now, because you've added so many to your portfolio, your kind of like snowball is growing that quickly that will allow you to think that, all right, now actually, I won't even put that into your mouth, right? Like you're thinking once a year buy one in your portfolio. Do you think that that's because you're aggressively saving from your active income? Do you think that that's going to come from this like pay down stuff that you're doing? And because now that you have eight, you're paying it down so quickly that it's going to add up to that? Like, talk to me through that.
So that's a dream to buy one every time. I
Sure.
think with Gribbon, I can do that
Yeah.
this summit.
Yeah.
Um, but absolutely, it's not from adding money from my W-2. It is literally keeping all of that income in the real estate bucket, right? So we don't take from that. We don't say, "Ooh, like maybe we need some money out of here." Like I'm very diligent about keeping that separate and letting that grow for retirement. That's what that's doing. So as it grows and as I see as it pays down or however, we can do that, there probably will be, equity somewhere to buy one. That's my plan.
I love it. I think it's bold and it's cool. Let's get some follow-up questions. So she had asked about the process. We said the process was easy, certain requirements that needed to be met. How would you quantify like the requirements that would need to be met for you to have done these refis? I would assume you have to have a certain amount of like debt to income. You can only take out a certain amount of from it based on like the extra equity
Oh
that
yeah,
you
like
have on it.
sometimes we'll say 70% loan to value. Like that's the amount you can do. Again, you always want it cash flowing, so you're not gonna take out too much. But with rental properties, a lot of times they'll look at, are they cash flowing? And if they are, the loan becomes easier because they are, rental properties. And with that, we always have the backing and the spreadsheets and everything to show like, yes, all of these are going to be cash flowing. So it makes it easier.
Awesome. Yeah, sounds pretty easy. I got one more question for you. First, I guess two. You're coming to the summit, right? Like I feel like you've explicitly said that at this point, but
Yeah, I'm there. Can't
I just
wait to
want to
see everyone.
confirm. Yeah, you and your husband, you're coming to the summit. So anybody that's coming to summit, you get to meet Sarann and ask her these questions in person. This is officially your introduction to everybody that didn't already meet you last year. Was
Yeah,
last year
yeah.
your first summit?
It was, yeah.
Awesome. Awesome. Very cool. I wanted to ask you about something you told me before we like went live here. You said you're never selling another property again. Talk to me about that. What did you mean by that?
I made that state. Obviously, anything can happen, but my goal is to never sell another property again because what I'm finding is going through all these years, right? Is that there is just continued appreciation in real estate. And because you can refinance and take all that out tax free and move it to another home or use it if you want to, right? There's just no better way. There's no reason to ever get rid of the asset unless it's just like something abominable was going on, right? Like there's no reason to do that. And when I picture having these 15 homes and having that rent, I also know that once I pay them down, I also know that at any point I can say, all right, I'm going to take $200,000 out of this one property and just put it in the bank or invest it very, conservatively so I know I'm not going to lose it. And I don't know, pay for a wedding, pay for a month in Europe, pay like these things can happen. These things can happen. So I just love the fact that I can take the rent or I can you can take a big chunk if you need to.
Hmm.
It's just pretty awesome.
I love it. I love you just putting it out there. I'll tell you, my wife and I love hearing that because that is one of these like recurring themes I hear over and over again on this show and in general for people that do real estate. Like I've never met anybody that's told me, God, I should have sold more of my properties. Like nobody's ever said that. Whereas I hear all the time, I wish I would have held on to XYZ, right? Like, or folks are either like, I'm never selling again after I realized once I sold this thing, like whatever. And it actually affected our decision making, my wife and I, right? Like we've thought about this. Like we've thought about like, hey, do we, sell one JWB property, you get another kind of thing. And I'm just like, no, no, I'm pretty sure that I'm going to go with this thing that I continue to hear over and over again is that everybody is happy for the longer you hold it, the better it goes. And it's like just a tenet that I've really gotten to believe of hold. You buy and you hold. And I think if you could have made it through with your Jersey property that you bought in 2008 and self-managed and went through like the 10 cat guy and all these different things, like, and you still believe this stuff of like continue to hold the properties and continue to add to them because of what you said, because your options when you buy and hold over a long time, they're just better than most other options of other things that you're in based on the control that you have, based on, like the different options for doing things pre-tax and like all these different things. I love that you come out and declare that, and it's something that because so many people have said it on the show. I've been able to like take those decisions and be a better steward of
Yeah.
my investments as well. So really wanted to hit on that again. So thank you,
Yeah.
Saran. Lou Carlson said, "I missed it. Are you in financial services with New York Life? Because I'd like to be a client." And he left his info. I'm going to send that to you. But before you get off here, anybody else that is thinking, "Oh man, Sarann is a financial advisor. I want to work with somebody like this." Do you want to give out any kind of like contact information or anything like that, and the type of people that you work with for anybody that wants to get?
Yeah, absolutely. Or maybe we were talking earlier, but yeah, I work with small businesses and individual investors to make really smart financial decisions and get to your goals and where you want to go. And I can give you my phone number. Is that
If you
or
like,
no?
sure. I mean, you're
Yeah.
going to get reached out to by the thousands of people that will.
Yeah, no. So my phone number is 732-996-2311. I'm happy to talk about any investing or just if you want to talk about real estate, because I obviously love it. And
Cool.
I appreciate that.
Yeah. 732-996-2311. Can people text you there?
Yep. Text
Okay.
me.
Text
And I'm
around, call
Sarann
around.
Jennings1@gmail.com. That's my personal email if you wanted to use that. But text me and then we can go from there. Easiest way.
There you go. So you want to get in contact with her. Sarann, anything else that I haven't asked you? Anything else that you want to that you want to share before we stop here?
Am I supposed to say don't be happy? No.
No, oh, we'll do that at the end. We'll do that at the end. Yeah. And
No,
yes, but not yet. Just anything else
no,
that yeah.
I'm super excited to have been on the show. I'm really excited to meet everyone that I didn't meet last time at the summit. I think it's a great community. I am appreciative of being part of it.
Hold on. Somebody just asked you to repeat the email. I'm just going to put it here in the text. Okay.
Yep, there it is.
There it is. There it is. I just pulled it out of my email inbox. Sarann, I'm super pumped that you're part of the community. I'm super pumped that you came last year to the summit and we got to know each other a little bit and that you reached
Yeah.
out
I don't
and
have a nickname though. This is the thing we need to discuss.
we got to get you a nickname. Got to get you a
Yeah.
nickname. Got to get
I
you a
guess I need
nickname.
one.
Yeah, I feel like I've been on a creative rut for nicknames, but you officially deserve one right now. So we will
Okay.
we
All
will
right.
figure this out. I promise you, you will not pass this summit without leaving with a nickname.
Yeah.
And man, I love the bold vision of every summit try to add one to the portfolio. Like I think you're the first person to ever like
Yeah,
verbalize
make it an
that.
event. I'm gonna
And
do
it is something that I've long like wanted to be brave enough to declare out into the universe. So you beat me to it. But I think that's really, really cool. And I appreciate all the knowledge that you shared. A bunch of people here. Sarann with a plan is Leslie's. Yes. Sarann with a plan. I like it, Leslie. This is what community is about, right? Like help a brother out. Or
it.
nickname Sarah Smiles. Oh, we got a bunch of nominations here.
Wow,
I
thanks
like
everyone for helping Pablo out.
Jeez, it just gets easier and easier to do your job. You're surrounded by really intelligent people. So, anyways, thanks for doing this. Really appreciate it. I really appreciate the community doing this.
Thank
Greg wasn't
you.
here because they're doing the State of the Union for JWB, which we will share next week at this time.
Yeah.
But really appreciate all of you for the stories like this, the fan appreciation show last week, just the value of folks that take an hour out of their day on Tuesdays to like come here and be part of this never goes unnoticed. Really, really appreciate it. And now, Sarann, last piece of advice for those of us until next week is what?
Don't be average.
Don't be average.